If you were looking at your screens just 24 hours ago, you were probably watching global markets breathe this massive collective sigh of relief.
Oh, absolutely. Everyone was relaxing.
Right. Like you were watching traditional finance try to price in a 5-day postponement of military strikes in the Middle East. It felt like a very classic diplomatic relief rally.
Yeah, that diplomatic illusion was, well, it was holding up the market.
Exactly. But today, that illusion of containment has completely shattered. I mean, missiles are hitting urban centers, global energy logistics are buckling, and legacy safe havens like gold are just completely breaking down.
It's an absolute geopolitical hurricane out there right now.
It really is. And yet, in the middle of all this, Bitcoin's microstructure is absorbing like hundreds of millions of dollars without even flinching. So for this deep dive, we really need to look at exactly how the digital asset market is surviving and honestly capitalizing on this macro stress test that is just fracturing almost everything else.
Yeah, and it is a profound divergence to witness in real time. I mean, we are watching the underlying architecture of digital scarcity completely detached from the panic bleeding into traditional analog markets.
It's acting less like a speculative proxy and more like a real-time barometer for global infrastructure failure.
Right. The legacy models that dictate how assets are supposed to behave during kinetic warfare are just failing right in front of us.
And that failure really starts with the physical reality on the ground today. Because yesterday, the market bought into a narrative based on a U.S. executive branch social media post claiming a pause in operations.
Which high-frequency algorithms aggressively repriced risk on.
Yeah, they bought it hook, line, and sinker. But the Iranian military apparatus explicitly stepped up today and called that U.S. claim, quote, fake news and psychological operations. And they backed up that rhetoric with immediate physical force.
They absolutely did.
The IRGC launched the 78th and 79th waves of what they are calling Operation True Promise 4.
Which, fundamentally alters the actuarial calculations of sovereign risk here. We have moved far, far past proxy skirmishes in unpopulated border regions.
Yeah, this wasn't an empty field.
Not at all. The telemetry data from today's strikes proves that a 100-kilogram explosive warhead successfully penetrated multi-layered Israeli air defenses.
Right. This was a direct impact on an upscale residential neighborhood in northern Tel Aviv. You have Mag and David Adam reporting this massive crater in the street, severe structural damage to multi-story apartment buildings, multiple casualties.
It's kinetic reality completely overriding the diplomatic narrative.
And on top of that, you have secondary targets near the Dimona nuclear facility and military hubs in Beersheba.
Yeah.
It is basically the exact definition of uncontainable escalation.
It completely invalidates any prior models of regional stability. I mean, when you demonstrate the willingness and the capability to strike precisely at the densest population centers and your apex strategic deterrence, the market has to instantly reprice the cost of global security.
So let's talk about how the market actually handled that repricing, because the mechanics here are fascinating to watch.
They really are.
Initially, Bitcoin tested a relief peak of around $71,810 based on that initial pause narrative. But as the reality of the strikes hit the trading desks, algorithmic systems immediately de-risked.
As you would expect them to do.
Right. The spot price dropped to an intraday trough of $70,250. But then it stabilized. It held the line near $70,490. But here is the massive anomaly, and I want your take on this.
Okay, go ahead.
While Bitcoin held that $70,000 psychological support boundary, spot gold suffered a catastrophic technical breakdown. It formed a confirmed head and shoulders top and erased substantial year-to-date gains.
Oh, it was a brutal chart to look at today.
So break down the mechanics for me here. Why is gold-like, the ultimate historical safe haven, failing so spectacularly precisely when warfare is escalating, while Bitcoin is absorbing that fleeing liquidity?
Well, it comes down to the friction of physical mechanics versus digital settlement in a high-interest rate environment. The legacy assumption, the old playbook, is that gold inherently protects portfolios when missiles fly.
Right.
But that analog model is collapsing under the weight of modern monetary reality. Think about the chain reaction here. When the Middle East erupts, crude oil prices immediately surge.
Which we saw today.
Exactly. And when energy costs spike, bond traders instantly look at that and say, okay, inflation is going back up.
And if inflation is going back up, the Federal Reserve cannot cut interest rates. They're totally trapped.
Precisely. They are structurally prohibited from lowering rates if the global supply chain is driving up the cost of everyday goods. So interest rates stay elevated. And here is where gold's physical nature really works against it.
Because it doesn't yield anything.
Right, gold yields absolutely zero organic interest. In fact, it has a negative cost of carry. It costs, significant capital to securely transport, store, and insure physical gold bullion.
Yeah, you have to pay guards and buy vaults.
Exactly. So in an environment where risk-free government bonds are yielding high returns, institutional capital looks at gold's storage costs and quantitative algorithms just aggressively liquidate it.
So the safe haven actually becomes a liability purely because of the physical logistics of owning it.
Yes. Bitcoin, conversely, settles natively on a digital network. It doesn't rely on legacy clearinghouses, and it requires zero physical warehouse space.
Which is a massive structural advantage today.
Huge. And crucially, through the frictionless liquidity of the exchange-traded fund wrappers, institutional capital can instantly rotate out of the collapsing commodities and precious metals complex and directly into Bitcoin. Gold is being suffocated by interest rate expectations, but Bitcoin is pricing in the reality of sovereign liquidity and borderless settlement.
Which brings us to the very real sovereign consequences of those energy spokes you just mentioned. Because the destruction of the diplomatic narrative in the Middle East isn't just a localized issue anymore.
No, it sends thermodynamic shockwaves globally.
Yeah, we are seeing the physical, structural breakdown of global energy logistics, forcing emergency action thousands of miles away. Yesterday, we knew the Strait of Hormuz was operating under severe restrictions and threats of naval mines.
Which was already a highly elevated risk environment.
But today, the Republic of the Philippines had to officially declare a state of national energy emergency. President Ferdinand Marcos Jr. signed Executive Order Number 110, citing the, quote, imminent danger posed by the Middle East conflict to their domestic energy supply.
It's a textbook example of contagion. I mean, the choke point for a massive percentage of the world's daily oil consumption is essentially paralyzed, and emerging markets are the very first to hit the breaking point.
And the mechanisms the Philippine government is deploying to combat this are just drastically regressive. They formed the UPLIF Committee to orchestrate national fuel rationing.
Rationing in 2026.
Yeah, and if you want a clear indicator of how desperate the situation is, look at the environmental rollbacks. The Philippine Department of Energy is deliberately reintroducing outdated Euro II petroleum products. They are actively suspending their stringent Euro 4 environmental standards just to keep their industrial generators and legacy logistics vehicles running.
They're choosing survival over emissions.
Exactly. On top of that, lawmakers are pushing to suspend fuel excise taxes to artificially cushion the blow at the pump. I mean, I look at the global energy supply chain like a tightly wound industrial spring.
I like that analogy.
Right. When extreme tension is applied in the Strait of Hormuz, the spring snaps all the way over in Manila. It forces a government to choose between upholding clean air standards, collecting vital tax revenue, or facing total economic paralysis.
That industrial spring metaphor perfectly isolates the sovereign dilemma. And this is where we have to look at the mathematical endgame of these policies, because this dynamic guarantees further fiat debasement.
Walk me through that.
Let's walk through the mechanism. When an emerging market faces a severe external energy shock like this, the government's reflex is invariably to subsidize the cost of living to prevent social unrest.
Sure, you don't want riots in the streets.
Exactly. But suspending the fuel excise tax reduces the state's revenue, and their sovereign debt obligations haven't disappeared. In fact, their debt servicing costs are likely rising.
So if you cut your own tax revenue to save your citizens at the pump, but your national credit card bill is still due, you really only have one option. You have to print the difference.
You expand the fiscal deficit. The central bank creates new currency out of thin air to cover the shortfall. This artificially manipulates their domestic market and relentlessly debases the purchasing power of the currency.
It's a trap.
It is the economic doom loop. As the currency loses value, the cost of importing that already expensive oil goes even higher, requiring even more printing.
Wow.
And this structural reality creates an organic, desperate demand from citizens and corporations for non-sovereign, censorship-resistant collateral. The systemic failure of the global energy supply chain accelerates the absolute necessity to hold an asset like Bitcoin.
Because no central bank can arbitrarily print it to fund a temporary energy subsidy. The math is brutal, but it's undeniable. And while these vulnerable sovereign states are degrading their own fiat currencies just to secure physical energy, well-capitalized corporate entities are using this exact macro chaos to aggressively secure digital scarcity.
The corporate siphon is in full effect.
Let's look at the corporate side of this, because the scale of accumulation today is staggering. We came into today knowing that institutional accumulation was a persistent baseline. We know ETFs act as structural sinks.
Right.
But today, we saw a massive acceleration in corporate financialization using highly specific equity strategies. First, on the ETF side, despite the missile strikes and the weekend panic, the U.S. spot ETF complex recorded a $167.2 million net positive inflow on Monday.
Which demonstrates that macroeconomic allocators are operating on a completely different time horizon.
They don't care about the news.
They are entirely price agnostic to geopolitical headline panic. They're systematically extracting supply from the secondary market regardless of what the news cycle is doing today.
But the individual corporate treasuries are where the mechanics get incredibly aggressive. Strategy Inc., formerly MicroStrategy, filed an 8K confirming the purchase of 1,031 additional Bitcoin for $76.6 million.
Putting their average cost at $74,326.
Yeah, but here is the critical shift in their strategy. They funded this entirely through at-the-market, or ATM, sales of over 509,000 Class A common stock shares.
Right, rather than the perpetual preferred shares or debt they were using earlier.
Exactly. This is a big pivot. And I have to push back on this mechanic, clinically speaking. If I am a shareholder of Strategy Inc., you are actively diluting my slice of the pie.
Sure.
You are issuing new shares to buy more Bitcoin. How is making my existing shares worth less a clinically rational corporate strategy?
Well, because you have to look at the premium. Under current macroeconomic conditions, this strategy is highly accretive to the shareholder.
Okay, break down the math of an ATM offering for me.
So Strategy Inc.'s stock typically trades at a massive premium to the actual value of the Bitcoin sitting on its balance sheet. So when they issue a new share of common equity, they're selling that share at a premium.
Okay.
They then take that cash and buy Bitcoin at the spot price.
So they're effectively arbitraging their own stock premium to acquire more underlying collateral.
Exactly the mechanism. By issuing equity at a premium to their net asset value, they are acquiring more Bitcoin per share than the dilution cost the existing shareholder.
That's wild.
To use a simple visualization, they are indeed slicing the pie into more pieces, but they are expanding the total size of the pie significantly faster than they are slicing it. The underlying Bitcoin per share actually increases.
That makes total sense when you frame it that way. But it's not just an American phenomenon anymore.
Yeah.
Let's look at the M&A space in Europe, because this takes the supply squeeze to a whole other level.
The Swedish deal.
Yeah, the H100 group in Sweden just signed a letter of intent to acquire two Norwegian firms, Moonshot AS and Never Say Die AS, but they aren't using cash. It is a pure all-stock deal.
Which is brilliant.
It instantly brings H100's consolidated treasury to 3,501 Bitcoin, which is roughly $239.7 million. So walk me through the mechanics of an all-stock M&A deal here. How does this specific structure change the global supply dynamics of Bitcoin?
Well, by utilizing a pure equity swap, the H100 group is engineering a highly liquid, publicly traded proxy for Bitcoin without ever triggering a taxable liquidation event.
That's the key right there.
Think about the alternative. If the founders of those Norwegian entities simply sold their corporate Bitcoin on the open market for fiat currency, they would immediately trigger massive capital gains taxes. The state would take a huge percentage of their wealth.
Right. Nobody wants to incur a massive tax penalty just to gain liquidity.
So instead of selling, they merge. They trade their private company shares for publicly traded stock in H100. During this transaction, no fiat currency changes hands at all. The cryptographic collateral, the Bitcoin, simply transfers from the Norwegian multi-sig wallets directly into H100's corporate treasury.
So it never hits the secondary market order books. It bypasses the public exchanges entirely.
It is a totally closed-loop transfer. These corporate balance sheets are basically becoming permanent, inelastic cold storage vaults.
A structural sink.
Yeah. When a company executes a pure equity swap like this, they are systematically removing massive blocks of digital scarcity from global circulation. This permanently counteracts any transient tactical selling you might see from retail traders or leveraged algorithms reacting to the news.
It functions as a one-way valve. The corporate treasuries act as a siphon, locking up supply indefinitely. But here is the reality check. None of these massive corporate treasuries would dare lock up hundreds of millions of dollars in digital assets if they thought the regulatory hammer was about to drop.
Absolutely not. They need certainty.
They are doing this because the regulatory environment is being permanently cemented to support it. Which brings us to the legislative plumbing happening behind closed doors right now.
The transition from conceptual negotiation to rigid statutory reality.
Exactly. Because last week, all we had was a tentative agreement in principle to unblock the Digital Asset Market Clarity Act regarding stablecoin yields. But today, the legal architecture is actually being built.
The briefing started.
Yeah, on Monday, leading crypto industry executives were briefed on the exact legislative text in closed-door Senate Banking Committee meetings. And today, traditional banking representatives are on Capitol Hill reviewing the exact same text.
Two rival cartels reviewing a peace treaty.
It really is. The U.S. government is acting as the ultimate beneficiary here. The parameters of this compromise are completely eye-opening. The text explicitly bans passive yield on stablecoins, but it legally permits activity-based rewards for platform utility.
Which is a huge distinction.
And if this holds, Chairman Tim Scott is targeting a formal markup vote for the second half of April, like right after the Easter recess.
The explicit ban on passive yield is the most critical component of this legislation. It is a massive calculated concession to the traditional banking lobby.
Let's contextualize this for the listener. If you're listening to this and wondering why the traditional banking sector cares so much about whether a digital stablecoin pays interest, think about your own checking account.
It's an existential threat to their entire business model. The commercial banks presented forensic analyses to the Senate, warning that if stablecoins were legally allowed to offer passive, risk-free interest, say 4 or 5%, the capital flight would be catastrophic.
Because everyone would just move their cash on-chain.
Exactly. Up to $6.6 trillion in commercial bank deposits could instantly migrate out of the legacy banking system and into digital stablecoin wallets.
$6.6 trillion that would break the legacy system overnight.
It would. The commercial banks demanded regulatory protection from that specific mechanic, and the Clarity Act provides it.
Okay, so the banks get their protective mode. But what does the United States government get out of this arrangement? Why is the Senate Banking Committee pushing this through so aggressively while global markets are melting down?
Because the state is actively domesticating programmable fiat to save its own debt markets, by clarifying stablecoin jurisdiction and establishing a compliant legal framework, the United States is synthetically generating immense, captive global demand for its sovereign debt.
Okay, look at the underlying collateral.
Right. Stablecoins must be backed by reserve assets, and those assets are overwhelmingly short-term U.S. Treasury bills.
The digital tokens are essentially just wrappers for U.S. government debt.
Precisely. Historically, the United States relied on the petrodollar system. Countries bought oil in dollars, and oil-producing nations recycled those dollars into U.S. treasuries. But as we see today, kinetic warfare and shifting alliances are rapidly degrading those traditional petrodollar recycling mechanisms.
The system is breaking down.
The U.S. Treasury needs a new buyer for its debt. By formalizing stablecoins, the government is using cryptographic architecture to permanently entangle digital asset networks with the legacy financial system.
It's a survival tactic.
They are cementing the hegemony of the U.S. dollar in a digitally native format, ensuring that no matter where capital flows globally, it is ultimately parked in U.S. treasuries.
It is an absolute masterclass in financial engineering. So, to clinically summarize the reality of the last 24 hours, the diplomatic containment in the Middle East has utterly failed.
Failed completely.
Kinetic destruction is active, with 100-kilogram warheads penetrating dense urban centers. Emerging markets like the Philippines are declaring national energy emergencies, sacrificing environmental standards, and mathematically guaranteeing the debasement of their own currency just to keep the lights on.
A doom loop in action.
Meanwhile, analog safe havens like gold are suffering catastrophic technical breakdowns due to the mechanics of high interest rates. Yet, amidst all of this systemic fracture, Bitcoin's microstructure is absorbing $167.2 million in daily ETF flows.
Put that a hitch.
Public corporations are relentlessly and profitably diluting their equity to lock up supply forever.
Yeah.
And the U.S. Senate is quietly finalizing the regulatory plumbing to domesticate stablecoin architecture and absorb the national debt.
The microstructural integrity held the load. The exogenous stress test of the last 24 hours revealed that the foundational bid for absolute digital scarcity is entirely decoupled from traditional macroeconomic panic.
Which leaves us with a final, completely unexplored implication to consider. If you're looking at this, you have to wonder, if corporate treasuries are systematically locking up the circulating supply of Bitcoin through aggressive equity swaps,
right,
and the United States government is formally domesticating stablecoin architecture to absorb massive amounts of sovereign debt, what happens to the remaining liquid supply of digital scarcity when the terawatt-scale AI infrastructure monopolies companies who are already consuming all available physical energy on Earth finally realize they must secure non-sovereign collateral to survive the next decade of geopolitical friction.
That is the ultimate question.
When the machines realize they need hard money, what is going to be left for them to buy? Let that sit with you. We'll see you on the next deep dive.